So for people that are all calling for a big market crash, I'm not convinced that necessarily can take place in an environment where you have a lot of other capital is being restricted and shut down, because it has to go somewhere. So, if you've got a bucket that's quite full and you've got three other buckets that are full, but those three other buckets have to be emptied and they can go into the one bucket, it can get much fuller.
Hey guys, welcome to Capital Cause. My name is Danny, and today I'm glad to have Chris MacIntosh and Brad McFadden by way of Capitalist Exploits, my favorite newsletter out there. Guys, thank you so much for coming back on Capital Cosm.
Yeah, thanks, Danny. Good to be here.
Good to be back, mate.
Yeah, definitely. Let's just dive right in, guys. Let's start off macro, and let's get your 30,000 foot view on where you see the markets, the economy. What's top of radar for you? And then we can kind of hone in on specific topics as we kind of mention them along the way. So I don't know which one of you wants to take it. Brad, Chris, what is 30,000 foot view for you?
Give us a take, Brad. I'll let you go first.
30,000 foot view. Well, I'm hoping that the Israelis are going to bomb the shit out of Iran. They close the Straits of Hormuz and oil goes to $100 plus a barrel. So there we go. Well, don't laugh. Stranger things have happened. I think from a 30,000 foot view, one of the big sectors we've been watching and invested in is oil, and we're watching how the U.S. shale patch is getting more and more gassy, which indicates that it's chewing through a lot of its resources. So we're preparing for negative surprises in terms of production growth out of the Permian Basin, and also the broader shale resource as well. So that's going to have a huge effect on pretty much everything. So that'll affect, obviously, energy prices. That'll affect inflation. Everything else sort of falls in between there. The frustrating part at the moment is the massive gap between value and growth stocks. The whole value versus growth thing. We thought we saw it all back in 2000, going back, 24 years now. That's freaky. And this has gone on and on and on, and it's way in excess of that. So it's testing one's patience, put it that way.
And Chris, what is 30,000 foot view for you?
Yeah, I mean, Brad touched on, jokingly talking about Israel bombing Iran and the shutting of the Strait of Hormuz and things like that. Here's the interesting thing. We have massive geopolitical tension currently. We have, so you could take that and put that aside. On top of that, we have the other thing that Brad mentioned, which is the shale, Permian Basin, Bakken, all the shale in the United States was, you got to remember, this was this bailed out humanity and bailed out the world in the last run, right? In that no one really sort of saw it coming necessarily, and the production that came out of that helped to mitigate massive inflation, which we could have otherwise had. That particular that's not going to bail us out this time. So we have declining production across all of the industries there. Oh, sorry, all of the basins there. And as Brad mentioned, they're getting more gassy. Basically, what happens is when a field starts producing more gas relative to oil, it goes into like a really rapid decline. And that's the other thing that is important here, because it's not just that shale isn't going to produce as much. No, it actually declines, and it declines sharply. Shale deposits are not the same as your sort of Gawar or your North Sea oil or any of these, where you have a much more steady rate of decline. These basically go up and then they collapse. And so think of that as a market disruptor. Okay, so that was the vast dominant energy resource on the planet for the last 20 years nearly. So if you take that away and you don't just put it in a situation where it's declining sort of, marginally. It's actually declining rapidly, which seems to be probable. And then you add in the fact that we haven't invested into anything in the energy space on a global basis, really, for the last 15, 20 years. You've got this enormous setup for a problem. And we also then know that energy is the bedrock to inflation, right? Because, the bread that you buy comes on a truck and it gets, the grain gets harvested by a harvesting machine, and it takes a ton of diesel and energy and natural gas and a whole lot of basically fossil fuels that are required to produce all the things that we have taken for granted. So when you couple all of these together, it just points to this incredibly stagflationary outcome. And historically, if you go back and you look at stagflationary outcomes, often they've also coincided with war. And guess what we've got? So I think there's on multiple fronts, we're pointing towards the same outcome. And this is where it actually gets quite exciting if you're a bit of a weirdo like us. The exciting outcome is that you have extraordinarily high prices in energy in particular, in commodities in general. And you go, okay, well, if that's true, then, are we too early? And it's like, you look at it, oil's trading at like $70. Natural gas is nowhere near its highs. None of the commodities are excepting gold, are anywhere near their highs. And gold's sort of quietly making these moves higher, despite there being almost no retail or even...
No one seems to care.
No, it's all central bank buying. And so, but then again, you go back in history, central bank buying is governments protecting themselves, and they do that when they go to war. So there's multiple reasons why, and I don't want to be a doomsayer at all. You can make lemons if you're given lemon, make lemonade if you're going to be given lemons. That's the situation that we have in front of us today. So almost no matter which way we look at it, it seems that we should be invested into the energy space in general. And then there's pockets within it that look really, really interesting to us. So, offshore drillers, things of that nature. But look, I mean, that's the 40,000 or 30,000 foot view is that we have a stagflationary environment that looks really, really dangerous. And at the same time, very few are positioned for it in the market, which we see as a good thing because it allows us the asymmetry that we have become known for, and investing into things that have got relatively low downside with extraordinarily high upside. So, and then that just brings up the last point that Brad made, which is that it's been frustrating. We're sitting here, Brad and I look at each other and we're like, what the fuck is wrong with people? Right? We like, the Iranians, the Israelis took out, after a peace deal, they took out one of the leaders in Hezbollah, and then the Iranians responded, and and then of course on top of it, you've got the Turks who turned around and said, you know what, if you guys go after to the Israelis, if you go after this, we will protect, we will basically go to war with you. So there's these challenges being made. And if you look at the geographies of it, Turkey, of course, controls the Bosphorus. Iran controls the Strait of Hormuz. And at the moment, to a large extent, the Houthis are controlling the Strait, the Suez.
Yeah.
And so, you've got three geopolitical choke points, any of which, if you shut them off, send oil to three digits in a heartbeat. And so often we're listening here going, we don't even need any of these things to actually even happen. All we need to have continue to happen is is decline in the shale production, which is taking place anyways. Some of the massive monetary inflation that's been taking place since COVID to start flowing through, and we get there anyway. So there's so many reasons. I find it difficult. When you try and counter your own arguments and second guess them, I'm like, what's a good argument for not having energy exposure? And I'm like, I can't think of it.
I recently had an interview with Martin Armstrong, and I kind of raised the same topic up to him, namely minimal risk added on to oil. There's a very small risk premium to oil right now. It did spike from $67 all the way up to the mid 70 level after Iran's attack or retaliatory strike on Israel. But in the grand scheme of things, I mean, you pointed it out. These commodity prices are still heavily pulled back from their highs in 2022. There doesn't appear to be any risk premium on these things. So I asked this question to Martin Armstrong, and he said that that's because there's portions of smart money who believe that they're just going to shut off the free market, i.e. price controls, and they're just not going to be a free market for this stuff. What do you think of that? What's your response? Do you think that's feasible?
I think, well, look, to some extent, we're watching some of that transpire. So I don't know if you just saw, but in the EU, they're looking at banning Tether. And Tether has been the tool being utilized by sanctioned countries to move capital. Because Tether's just, it's basically US dollars. It's backed by treasuries. Well, we're told it's backed by treasuries. I haven't audited it, but it provides for the liquidity that you would need. It's a Bitcoin, but with dollars is one way to think of it. And I know all the crypto guys are going to lose their minds about that statement. But that's a good way to think about it. It's blockchain technology, which sits outside of the Western financial system. Hence, it can't be controlled accordingly, but it's still dollars. So it gives you the liquidity that is available in the dollar system. Anyway, so that's been utilized at increasing scale across the world. And so now we see the EU coming out and saying, oh, we're going to ban them. But that's not a surprise. Why? Because they're trying to shut down these avenues of means of capital movement. So yes, that's just a step towards the capital controls, which I've always said are going to be coming at some point in Europe in particular. So I agree with that statement. The other thing that I would point out, however, is any time that we've had something of that nature take place, it's always creates shortages, and shortages create higher prices.
Mm-hmm.
Yeah.
So what
you bring in capital controls, it just forces the price higher. Look, the reason that cocaine costs a lot, I think, I've never tried it, never bought any, but I understand it costs a lot of money, is because it's a controlled sanctioned market. And so if you made cocaine legal, the price would collapse tomorrow. So same thing, when you put in capital controls, when you constrict the flow of capital, the underlying prices of the goods that people need will go higher. That's always what happens. Yeah.
Now, sticking to the energy topic, why do you guys think that there hasn't been a stronger risk premium on energy despite all these things you mentioned, right? I'll let Brad take this one, and Chris, you can follow suit afterwards.
Yeah, it's bizarre, isn't it? Like when you see the sentiment towards energy, if you look at position of the futures market, it's more negative now than what it was at the worst of it in 2020, and it's more negative than where it was in 2016, wasn't it, when oil was $30 a barrel. It's at record lows as far as records go. And if you look at how equities are positioned, I see there's a thing out from Goldman Sachs a few weeks ago, whatever it was, 10 days ago, saying this is the lowest that the hedge funds have been in terms of weighting towards energy equities. Well, it's on par with the lows of 2020. So, yeah, fine. Now, why is that? Well, is it this big sucking noise we hear from the growth stocks, from the Magnificent Seven and all its supporters? I think that's got a lot to do with it. I'm not going to get involved in conspiracy theories, etc., to keep the oil price down. Of course, the price of oil going up I, as far as I can tell, it's just that people have there's this one trade on, and that is the Magnificent Seven growth stocks, and that's it. Everything else gets shunned by, and it gets pushed by the wayside, which does create. When you have this massive negative position slash short positioning, it won't take much for these stocks to rally and rally hard, big time. But it's bizarre, Danny. It really is bizarre. I rarely do we come across situations like this, and I'm not 23 anymore.
Because it's really interesting because you see risk being priced into gold, right? You did mention all the central bank buying because the central banks are pricing risk in.
Yeah. But that's the important thing. It's central bank buying. If you look at commercials, if you look at fund managers, not interested in gold, not interested in energy. Here's an interesting thing. I spoke with a good friend of mine who runs a large asset management firm. Well, he's not an asset manager. He runs a firm that does brokerage and custody and a whole bunch of things. Long and short of it is he has a lot of fund managers that are on his platform that he speaks to. And he had a conversation with a multi-billion-dollar fund manager in New York. These guys are, by and large, they're very myopic. They're very concentrated and focused on the US markets in particular. Their understanding of like geopolitics is rudimentary at best. He was having a conversation with him talking about things going on in the Middle East, in Europe, and the guy was like, yeah, we don't worry about that. Not really understanding that the world today is not the same as the world 40, 50 years ago. 40, 50 years ago in the US, you could do that. You were the dominant market. Almost nothing else mattered. And today that weight has changed considerably. I mean, China today is the largest economy in the world by depending on how you measure it. But, we can argue over the nuances of it. But by and large, it is significantly larger than it was before, as are many other economies. And so, this ability to just sit there and be like, we don't have to worry about them. They're just, rats and mice on the corner. That sentiment prevails in the markets today across asset managers as well as retail. And I think it's a mistake. And so I think to some degree, that's why you're seeing the sort of positioning that you're seeing. The other component, of course, is the Mag 7, which has done so well. It feeds on itself, right? So you've got a lot of investors that have done well in the Mag 7, so they just keep going into the Mag 7. And so as the capital flows come in for pensions and everything else, they keep throwing the money into the same pot. And so one could argue that's part of it. But yeah, I think a big portion of this is a misunderstanding of geopolitics. And when you look at most of the capital aggregators in the world, they're based in the United States. And I would suggest that a lot of them don't necessarily have a skill set in the macro geopolitical world. When they talk about macro, they're talking about macro within the United States. You can't do that anymore. So, we know it's one of those things you keep getting taught lessons, and we need to go all the way back to the energy crisis in the 70s when the oil embargo took place to understand that that even though the US is the largest market, it isn't completely immune. And again, we talked about shale oil, right? So the idea is, we've got our own oil. We don't have to worry about those monkeys over in the desert. That's not going to bail it out this time. And there's obviously other factors involved as well over and above the energy side, which is to say that the United States used to produce and manufacture a large amount of its own goods. It doesn't anymore. It almost manufactures nothing. It exports dollars. And it takes those, and the manufacturing bases have all moved into Asia, or a lot of them. So that's where the actual production of things takes place. And so it's a different environment. But um, that's I think where the opportunity lies, you know?
Yeah, totally. And BRICS is leading the way on this charge. However, we did see their meeting yesterday come into fruition over there in Russia, but there wasn't any announcements towards a gold-backed or commodity basket-backed currency out there. Any insights that you guys were able to pick out of that meeting from yesterday?
Yeah, I didn't anticipate anything out of it in terms of a statement with respect to what that currency looks like. This puzzled me for quite a long time because, um, oh gosh, when was it? It was just before we went to El Salvador, maybe 3 months ago. I was looking through the whole BRICS, they had all these statements about a BRICS currency and everything else. And you have there's two sides of things. One is all the pundits talking about, oh, the BRICS are going to come out with a currency. Oh, and it's going to be gold backed. Oh, it's going to be commodity backed. And all of the statements that have been made by people external to the actual players involved in BRICS. When I read through the statements that were made by the individuals that actually make the decisions in within the BRICS nations, nobody mentioned commodities that were going to be backing this currency. Nobody. Then when I came across a video that a friend of mine sent me, and I shared it with you, Brad, that one about Tether. This is my potential hypothesis, actually, and I don't know if it's true, but the Chinese have now about $1 trillion in treasuries. This is another component. I'm just diverging a little bit. People have been saying, "Oh, the Chinese can kill the US dollar market, right, by just dumping all their treasuries." The reality is they're not going to do that because it'll harm themselves. It'll also harm all of their trading partners who are indebted in dollars and are trading in dollars. It would destroy much of the market. It would destroy their capital flows. It doesn't make any sense. What they have done is they repatriated all of those treasuries to Chinese banks, which makes sense because the Russians learned the lesson of not having their own domestic, having their capital at home, right, when they got their $300 billion of reserves nicked. So the Chinese have moved all of the treasuries back to China, and they've been pushing through via Hong Kong a digital-backed currency system. My suspicion is that they could utilize their treasuries on that blockchain system and switch it one for one. So much, and Tether's already shown us the pathway to doing this, right? You already have all of these sanctioned countries who are trading internationally now via Tether. So you have these massive cross-border flows in billions of dollars, still using the dollar. They don't have to not use the dollar, right? But you don't have to use the Western banking financial system. China has the ability to do the same things, but instead of using Tether, they just create their own, presumably not decentralized, back it with their $1 trillion worth of treasury hoardings. And guess what? They have now the ability to trade outside of the Western financial system using the dollars that aren't even theirs. And if they were smart, they'd put into those contracts that they now have with their trading partners and say, if on a point of call, at any time we wish to, we will swap these for yuan. That would be smart, because what you would do, let's say you and I were trading, okay, Danny, I'm China and you're freaking Uganda or whatever, and we've built a port there and we've got, some trade deals going on. You already owe a whole lot of money in dollars. Okay, now you're just going to owe me the dollars, right? And that's how we've got it anyway. Now we just swap it. We say, well, it's still dollars. It's still US dollars. We just own them. We got them in our treasury. And we'll call it USDCG, whatever, fucking something else, right? But so it sits on a different system. There's no reason why you wouldn't take the deal. It's one for one, okay? Also, it allows the ability to trade without the threat that the US could come in and sanction us and block our trade or anything of that description. Now we just put in the contract and we say at any point in time, we can swap this dollar for our own currency. Now, if you did that across all of the Chinese existing systems, like all of their trade partners, there would be, God knows how much, haven't done the numbers on it, but you would have now this massive trading block, which if the Chinese ever wanted to actually kill the dollar, they just switch it and they switch it into yuan. So now the dollar demand goes away. Basically, they've got flexibility, and the trade is already there. That trade is already in place. The deal's already done. Now you just subvert and you just flip it and you turn it into yuan. Your yuan demand would go through the roof. Your demand for dollars would be substantially lower. I'm not saying they're going to do this. I'm just saying there's a that is entirely possible. And we are seeing that they're pushing through a digital currency via Hong Kong. We've seen Tether already basically proving the model. So anyway, so that's where I think things could be headed. Yeah.
And conversely, is there anything the United States or the collective West should do or could do to maintain hegemony, or is this simply simply like a predictable thing? Are we just in a Thucydides trap right now with the West, pretty much collapsing on the scene?
Well, the risk is that when technology overtakes you, which it always does, that the existing players revert to alternative motives, which is typically war or conflict of some description. If you can't win on the battlefield of the sort of financial technology, then you'll try and win on the battlefield of propaganda technology or via military technology, shut down their satellites, any number of different things of that nature. So again, when you go through history, that's like, there's many weapons that can be utilized by parties, and they'll try and use those which, work and they see as a benefit. But it's too hard. We're pontificating around these things. I think what you got to try and always bring it back to say, well, how would you position? What would you do? All of these things, again, are very stagflationary. I don't think we need to make the judgment call as to say, do we want to be invested into the Chinese yuan or the US dollar or anything? No, you invest into the goods and services that mankind will always need. And fortunately, they're the cheapest they've been in at least on a inflation adjusted basis for like 100 years. They're the cheap as chips. So that's, I think, where you invest. And ultimately, that's your currency. For me, I'd rather own barrels of oil or gold or both than I would try and figuring out some new digital currency and who it's run by and what it's backed by or any of these things. Because currency really typically is just actually a medium of exchange. In order for it to have any value, of course, it needs to be backed by some valuable item. Why not just go after the valuable item? Buy that. If it's cheap enough, which it is today, buy that. Stop worrying about, what the mechanism would be used to denote the value of that barrel of oil, whether we price it in Malaysian ringgits, US dollars, Bitcoin, doesn't matter.
Brad, what do you think? Do you agree with Chris's assessment there?
Yep, completely.
And so
it's something to say, but yeah, it's panning out that way.
Yeah. So for the average investor out there, aside from, completely going off the grid, to avoid this stuff, what is, the top, what are the top three things that the average investor could do to prepare for this coming world? I'll let Brad, do you want to take this one?
Well, the one overriding thing is invest in physical stuff that famous writer Dennis Gartman used to say that when you drop it on your foot, it hurts. Um, if you look at the physical stuff, it has been, left for dead, underrated, undervalued for a long, long time. Everything's gone into these sort of financial assets, dreamland type stuff. Now, when I say physical stuff, it's not just gold. Obviously, it's essentially commodity based. Those things for which the supply cannot be increased dramatically. And so our thinking is that within the coming decade or so, it'll be the physical stuff that does exceptionally well, the stuff that's actually tangible. You can get your hands on it. It's not Mickey Mouse stuff So we're expecting energy stocks to do well. Obviously, base materials, gold miners, so on and so forth. And we can argue what is going to do perform the best. But I think if you get that macro theme behind you, it doesn't really matter what you do. It's all going to do pretty well. And we think energy in various different sorts will do exceptionally well. But there's other assets out there. Yeah, that's probably the key thing. And I think what Chris alluded to before when we first started the presentation, particularly in the energy space, we had that massive kicker with Shell coming online, 15, 20 odd years ago. There is just not anything to replace that coming online now.
Yeah. And then at the same time, you have all these geopolitical hotbeds, just with all of this built up potential energy at the scene.
Well, that's right. We never really invest based on
right, but it's kind of like icing on the cake, right?
It's icing on the cake. But the main fundamentals are there. Maybe like a hot war in the Middle East could really push things, but that's not why we invest. For us at the moment, that's like a free option. Something happening over there. It's not priced into the market.
And Chris, what do you think the average investor should be most aware of? What are some of the action items that they should really consider given this unfolding world?
I don't know. I mean, you buy what's cheap for starters, and if you just rummage around the world and look at what's cheap, you're driven towards the sectors that we've been discussing here. There's others as well, which we've not mentioned, but instead of telling people what to do, think about how to think about the world and how to think about allocating capital. If you focus on that which is cheap both on a relative as well as a long-term basis, what you come up with is largely in the stuff space. It's the shit that lands on your foot and hurts. And then you ask yourself the question, are we in a Kodak moment? i.e., does this stuff go away? Do we not need it anymore? And some of that has been put forward as a story, where we're told that we don't need fossil fuels and we're going to run the world on all sorts of wind or other things. And so that brings up another topic, which is, I think, one that Soros mentioned in one of his books, despite the guy being a bloody old codger. He had some good insights, and he talked about find the narrative and the premise that is wrong and bet against it. And the narrative that is, to our way of thinking, completely wrong is that we don't need fossil fuels, we won't need them, and we're going to run the world on alternative renewable resources. That's proving itself to be a disastrous strategy, aside from the fact that it's not actually possible. So then now you have these setups where they are extraordinarily asymmetric, whether it be coal, uranium, natural gas, oil, across the commodity chain. I would suggest that a big enough portion of your portfolio should be allocated towards those sectors, and then diversify across them. Because the other component that people need to understand is they are very volatile. But volatility is not risk. So you can have a price of, especially some of the equities that we get into, whether small or medium cap equities, you can have a huge amount of price movement for almost no reason whatsoever. And people often look at that and they go, "Oh, this scares the shit out of me because it's just moved 10%, and I don't even know why." But that's because it's an $800 million market cap company. Of course, it's going to move 10%. For no reason at all, and that doesn't affect the outcome of the company. And people will look at that and say that's risky, and then they'll go out and they'll buy Nvidia. Why? Because Nvidia doesn't exhibit that volatility. But Nvidia is trading at what, 90 times earnings or something? Like it's madness. Like I wouldn't buy that if you put a gun to my head. So I think part of it's understanding basically investing. And if you don't, then diversify sufficiently so that when that volatility inevitably hits, you don't get frightened out of your positions. You don't freak out and go, "Oh my God, I've got it all wrong and I'm down 10, 20%. Well, no, you're down 20% because you've just bought into small cap companies. So that's how I think best to think about things. And also to read as much as you can, read history, because all that we're going through now it's just a mirror of what has been happening for century after century after century. The only difference is that what we're going through now is not something that happens every 10, 20, 30 years. It's what happens every 100 or 250 years. And so as a consequence, you look at it, people go, "Well, my mother or my parents never went through that." No, they didn't, because it takes often 4 generations to go through a real cycle. So if you understand those cycles and understand the probability of them, then I think it's easier to make a more rational decision and not just run into the S&P 500, which is basically now the Mag 7.
What exactly are these cycles that you're referring to there? What is this 100 and 250 year cycles that you're talking about?
So there's a revolutionary cycle, which is about 250 years, which we're bang on. Happy days.
Mm-hmm.
There's a credit cycle of 30 years. There's another one of 80 years. We're bang on both of those. And yeah, so, and then of course you have within it, you have other, like there's a commodity cycle, right? That can run anywhere from 7 to 15 years. Our belief is that it's kind of evident to us that we're in one. I suspect that this is going to be one for the record books. I think it's not going to be an ordinary sort of, ho-hum cycle, which can and are very profitable if you get behind them in any event. But this one looks to being a bit of a humdinger for a whole host of reasons. You've got all your fucking you have all of your DEI hires running around. Nobody wants to invest into anything that's deemed to be, nasty, toxic to the planet, or any of this nonsense. Geopolitical. I mean, we covered all the various things, but there's a whole host of reasons why one could argue that this cycle is likely to be more dramatic than previous cycles.
Yeah, it does appear that you have all of these ley lines crisscrossing each other at the exact same time. You did mention all of these cycles, but then you also have all of these wars going on all around the world. You have the resource wars, the resource scarcity. You have this AI race. You have the energy. You need energy to keep these AI data centers running. And so you have all of these things that appear to be happening at the same time. You have the sovereign debt crisis that's around the corner. So all of these things appear to be converging at the exact same time in place, which, I'm not a historian per se, but I can't think of a time in history where you had this many potential ticking time bombs ready to go off at the exact same time. Can you spot any other time in history that's kind of reminiscent? Of course, we've got the high-tech overlay of our society today, but is there any other time in history that's kind of akin to what we're going through right now?
Oh gosh. Yeah, look, every time's I suppose a bit different. The other thing is I think when history books get written, the dominant factors get written about, and there's a whole lot like there's things that we're experiencing, which I suspect in 40, 50 years' time won't get written about because they weren't deemed to be the major contributors to what transpired. Um, but we we keep repeating it. We've been here before. There's different components. There's different technology that exists each time. um, so I would say the world's more connected now
Mm.
than it's ever been before, and that could certainly make things more egregious, I guess, than maybe in the past.
Would we say it's more dreamland now, Chris? Where, yeah, yeah,
It
you can.
feels like it, but then I wonder, Brad, like it feels like people are. I mean, the average person's running around
You
watching
know, yeah, I
Instagram.
mean, I can wake up, I can wake up tomorrow and be a woman.
Oh yeah.
Yeah,
Won't be a very good looking woman, but you know, I can be a woman. Guys can play in women's, sports teams, and guys can punch girls in the face in Olympic boxing matches, and it's like, yeah, that's fine, it's completely acceptable. Like that's just an example of the dreamland stuff. When I say dreamland, untethered from reality.
Well, that's common
but
for
again, we have
collapsing
been here before.
civilizations. Yeah, that's common
I
for
was
collapsing civilization. What like a common tendency with collapsing civilizations that they always end their life where when they're in the process of collapse, they begin experimenting with gender. Like it's so strange. Like you'll see
Okay.
this in Rome, you'll see this in many other places.
Weimar. I was just going to say I was reading about the Weimar Republic, and
Yep,
there's
that's so.
prior in that period, like transgenders, all this sort of stuff was huge. There was homophobia, basically this like anything goes attitude, right? All the sort of moral or religious constraints that exist often in societies, which and you can argue whether they're good or bad, and doesn't really matter. The point is, in many societies, you'll have something that holds that structure together, right? If you go to the Middle East, it could be Islam and the various tenets that go with it, and that can be dress sense and decorum and a whole lot of things. But that holds that society together. There's an understanding of how things work and how you conduct yourself and so on and so forth. Christianity's at it anyway. So religion is one of the concepts, but what we've got now is this anything goes. It's completely anything goes. And again, that was exactly what you saw in the Weimar Republic. Just and profligate spending. Like, so people were spending, even though there was high inflation, and that people were spending money on ridiculous shit. And I'm like, how is that different today? you know, so it's like I say, we're repeating what has happened in the past, but we just have different things. I mean, think about NFTs. People were spending. What was that guy Raul was talking about? Like spending like $50,000 or something stupid on some like monkey
Oh
JPEG, right?
yeah.
Which is
Wasn't
now
four hundred
worthless, of
thousand
course.
dollars?
But
Um,
eh?
yeah, it wasn't $400,000, but
Yeah, that's right. Anyway, it doesn't matter. The
yeah,
point is, like, it's frivolous spending on ridiculous nonsense. At the same time that there's an anything goes attitude in the world, we're seeing the same thing. Sorry, go on, Brad.
well, so we could see it in stock prices of these high flying AI tech companies. You're paying 80 times PEs, 100 times PEs, and so on and so forth. Is this also and is this also a reflection of cheap money? If money wasn't so cheap, capital wasn't so cheap, didn't take interest rates to like zero or negative in some cases in the previous last 10 or so years, if that never happened, would we have seen all this stuff? So when money becomes cheap, people start doing really dumbass things with it.
Mm.
And it's not just doing things with money, but your behaviors start becoming dumbass as well.
And reckless.
Reckless. Are we just too damn spoiled? I know in Aussie and New Zealand, well, I suspect a lot of problems we've got. It's just we've had it so good for so long, the lucky countries, and people are just spoiled. When was the last time we went through a recession in Australia? 1990. Well, that's when I came out of university. Cheapest, So I'm 54 now, so no one less than 54 has gone through a recession in their working life in Australia and New Zealand, so on and so forth. So I think we're acting like a whole bunch of spoiled brats. Probably too much optimism, too much cheap stuff.
And it's not just confined. It's not just confined to the public. You see this in the elite class as well.
Yes.
And this isn't the first time I've said this on my show, but you look at the elites of olden days, the Kissingers, the Brzezinskis, the Rockefellers. These guys, say what you will about them, but they were all very rational men. They're all very clever men. The elites that we have today are insane. They're actually consuming their own refuse.
Yeah, you're right.
So they pumped all this. Man. Yeah, they pumped all this propaganda to the public. They pumped all of this nonsense to the public, but in turn, their kids, like the Alex Soros, like these guys, like their kids have consumed their forefathers' propaganda, and they've become insane in and of themselves.
Yeah.
That's how you get the Trudeaus of the world.
Yeah. So we have covered quite a few topics here, guys, and you guys have made the points that when you're looking at these commodity and energy resources, that they're incredibly cheap, especially compared to where they were in 2022, and especially on an inflation adjusted basis. And even when you look at this stuff like relative to the S&P, it's historically cheap. But my question to you guys, and this is kind of a conundrum that I fall into with some of my guests here on this channel, is when is something sufficiently cheap? Because there's an old saying, I don't know if it's old actually, but there's a saying out there that how do you lose 99% in a holding? Well, first you've got to lose 90%, and then you lose another 90%, right? So how do you determine when something is cheap and not just a falling knife? Brad, I'll let you take this one if you want.
Well, or how cheap do things get? I mean, yeah, you're right. I mean, you can buy something that's down, what's something down 95%? Something went down 90% and halved, or so on and so forth. Look, when sentiment, I think sentiment is probably one of the biggest things, if not the biggest. It's like the 80%. And when you get record lows in sentiment towards, let's not take a stock. Let's a sector, a theme, call it what you will. When you have record lows in terms of sentiment, and it's been that way for some time, it's a dead giveaway that not many people are positioned in that market, that sector, that commodity, etc. I mean, how you define cheap? I don't know. We tend to stay away from the whole cheap thing, but that implies doing discount cash flows, etc., etc. It's like the market has a wonderful way of sorting out extremes. It goes from one extreme to the other. We know from studying on history that mean reversion is one of the greatest forces in the investment universe. Things do tend to mean revert, but sometimes things take a lot longer to play out. When you get extremes in terms of sentiment, then you get an underinvestment in that sector. Underinvestment equals less capacity, so on and so forth, and it repeats itself. So I think Chris and I spend more time trying to understand the real sentiment towards the sector. the vitality of that sector towards the functioning of society. And when we get, look, put it this way. If you go around the world looking for sectors and markets where the sentiment is absolutely toxic, we call it like, toxic, looking for toxic waste. And you fill your portfolio with all these different blocks of toxic waste, be it subsea service companies, be it coal miners, be it shipping companies, so on and so forth. You put them all in there, it's really, really hard to go wrong as long as you're patient enough. Because you've got asymmetry on your side. When things go right with these sectors, you don't double or triple your money, you make a multiple on that. And they can make up for various other losses. But so a long way of answering your question, and I don't even know if we've answered it, Danny, but sentiment plays a vital role in what we do. We're always looking to invest in toxic waste.
Mm.
And this is often it exists in little areas of the market that, for example, subsea service companies in Singapore, the cigarette distributors in Israel, all over the show. That's what we do. That's our bread and butter. Looking for pockets of value throughout the world, bring it all together. Or at least what we see. Well, I say pockets of value. There's a valuation thing coming again, but looking for things that are really, really out of favor and having a basket of all these out of favor sectors and markets in our portfolios. There we go. That's what we do.
One of the things you can look at, and we saw this with coal, was, again, you had sentiment, which Brad referred to, but you had incredible profitability. You had the companies where they could buy back the entire free float with their free cash flow in 2 years. Right. So you just have this immensely profitable company, and you look and you're like, why is it trading so cheap? Is it going away? Like, well, if it's going away, then why is it so profitable? It's not normal that profitable businesses go away. And then again, back to Soros's comment, find the narrative that's wrong and bet against it. The narrative was that we're never going to use coal. Coal's a dirty old industry. We don't need it. Coal plants all across Europe have been shuttered. Don't need it. It's going away. That's the narrative. It's wrong. So you bet against it. And guess what? You could bet against it with very profitable companies with valuations that were trading at what was Stanmore was like 4 times earnings.
Yeah,
I mean,
P's are 4 and 5.
So there's a good example of just, how cheap is it? Could it get cheaper? Sure. But is it going away? Not likely, because it's making so much goddamn money. Like, why would you go away? You're not going anywhere. If we 3 of us had a business here and we had a free float and other people think the company's not worth anything, but we're printing money, we'll go, cool, we'll just buy back the stock. Why wouldn't we? That's so, and we're not going to go away. We just, So those are golden opportunities.
Sometimes you have those dead giveaways, Chris. You have situations like we had with coal miners a few years ago, where these things were left for dead, unloved, unwanted. Stock prices had collapsed, and yet it was like you're buying these things on P's of 3, 4, 5. It's like, huh? That's cash flow here and now. And then you could make a guess in terms of what cash flows will be like in the future, but that wasn't hard. And then we had the same situation also a couple of years ago or 3 years ago in Argentina. We came across stocks there like, they'd fall on goodness knows what, 80-odd%. And yet you're buying these companies and they're producing cash. Banks on P's of 3 or 4, dividend yields of 6, 7%, amongst others. So that was like pretty easy. Then other times you come across sectors that have been bashed and yet, they're not making a profit, or making losses, going through bankruptcies. That was particularly the case with the whole offshore oil service space in the last 5 or so years. And then you've got to sort of make a bit of a judgment call. Well, what would the earnings likely be, say, 5 years out? That's a bit more tricky. But anyway, there's a few tricks up our sleeve to address that. So, yeah, sometimes, Danny, it's easy. it's just staring you in the face, like, huh? And other times you got to do a bit more work behind the scenes.
And what about the reverse case when you're on the sell side? How do you determine when something's too expensive? Is it just the same principle except in reverse?
Yes, usually it's when usually what happens is sentiment. People start talking good things about a sector or market. It's a bit of a trick because you've got a market that's been out of favor for 10 or so years. I've done one or even more so. When the bull market comes, it usually surprises everyone in terms of duration and magnitude. So we try and drag the chain a bit and run with the crowd. But yeah, it's usually sentiment. It's not often. It's not valuation. We don't look at a stock and go, oh, that's too expensive now. It's more so, well, it's attracting too much attention. And then often what happens is we find something else we quite like. And it's like, okay, well, we're fully invested, so where's the money going to come from? Well, best we start taking some money off the top here of this sector or market that's done exceptionally well, and people start talking about good things about it. They start taking money away from there, and we start buying some Mickey Mouse stock in Malaysia or sector in Malaysia or whatever. That's usually what happens. It's a relative thing, but again, it's coming back to a one-liner. It's all about sentiment.
So let's try this exercise with gold. Gold's risen from, blasted through its old all-time high of 2150. It's now sitting at just around in the mid 2600s. Although it appears to have rallied quite a bit, you guys mentioned that there really wasn't much retail interest. It's all precipitated by central bank buying by way of the East. So using your principle, this would imply that even though gold has rallied, sentiment still isn't there, and therefore it's still cheap enough, right? Would you agree with that assessment?
Yes. Look, it was a lot easier. It was a lot easier back in 1999 when gold was at $300 an ounce and bottom at $275 an ounce. I think it was. That was a lot easier back then. But yeah, no, it's still like, do you hear of fund managers talking about, oh, yeah, I better put 5% of my holdings in gold? It's like, hell no. I can't dare be underweight Nvidia, Microsoft, Amazon, etc. So, in general, no, there's sentiment. It's just ticking away in the background, and people are so overweight these tech stocks, AI stocks, call them what you will, that they're underweight gold miners and gold.
There's another component to it which I think exacerbates it, which is hold times on equities. So if you go back to like the 1940s, the hold times was calculated in the years.
Mm-hmm. I know the chart you're talking about. I've seen it before, but yeah, go ahead.
It's below 3 months now. So when you're an asset manager and whatever you've bought hasn't performed in the last 3 months, you fear redemptions. So you're forced into everything that's moving in a certain direction, because 3 months is nothing. I mean, like, you buy something and it's like, oh shit, it's the 10th of the month. Oh, it's the 15th. Like, oh, we're like halfway through our hold time on a 3 month time frame that people will be holding. And guess what? If it hasn't moved in the direction we need it to be moving in, that's a problem. So that materially affects how people act, right? There's a misconception that asset managers typically will do what they want to do. Very few do. I mean, Brad and I are anomalies. Like, we shouldn't be thought of, I guess, as asset managers in that light. When you think about these big global aggregators, they're there to earn fees. They're there to accumulate as much capital under management and earn fees in it. They don't really care so much.
You mean we shouldn't expect to see you on CNBC anytime soon, Chris and Brad?
No, probably not. No, I don't think so. No.
So, but yeah, so it's important to understand that the way they allocate capital is very much market driven, if that makes sense. The market's got to be going up for them to go and allocate any capital towards it. If it's not, they won't do it. It's too risky, far too risky. And so when you take that on aggregate across billions and billions of dollars out there at scale, you can see how you actually get these extraordinary extremes that we're seeing, both on both ends of the spectrum. Both ends of the spectrum. So the Mag 7 today make up a greater percentage of the S&P 500 than the dot-coms did in the dot-com era. The bubble that we're seeing there is many times the size of the dot-com era. And that's partly, I think, due to this sort of market mechanism where people's hold times are so short, which forces your asset managers are like, oh shit, we know we shouldn't have bought Nvidia at like 60 times earnings. It didn't make any sense, but look, it's at 80 times earnings. We should have done it, right? And so it forces market behavior until at such point as you have exhaustion. I have no idea where the exhaustion comes, and I don't really care. We just sit and patiently wait. We'll buy something and be entirely happy if it doesn't do anything for 12 months. I don't care. We're like, it's all right. Again, you're looking for that asymmetry, because when it does move, it can go 3, 4, 5 times within 12, 18 months.
And the other relevant component is your position size, because you wouldn't be able to wait as patiently as you would have if, let's say, 50% of your net worth was in one asset, right? It's got to be spread out in a way that, if it does go to zero, if you do take a 50% haircut, it's not the end of the world.
Yeah. Got it.
Yeah. Well, I think we've covered a whole host of topics here, guys. Before we wrap up, I want to get your thoughts on what are some of the biggest concerns on your plate right now, considering everything that's going on in the investment world, finance, economics, geopolitics. What is your biggest concern now? Let's start off with Brad. What do you think?
The biggest thing I'm looking for is I'm looking beneath the scenes and what's happening in the US shale industry. What's happening in terms of production coming out of there. What I'm looking for is a peaking, specifically in the Permian Basin. Evidence of a peaking there. If I get that right, pretty much everything else falls in place.
Gotcha. And Chris, what are your biggest concerns right now?
Probably capital controls. They seem inevitable, especially in Europe, and how that's going to affect markets. It's something that we've been aware of, but I think it's accelerating now. I'm just seeing more and more rhetoric as well as actions being taken by the authorities that point towards that being an inevitability. And so then it's trying to extrapolate and see how does that affect other markets. I think it forces capital to some degree into the United States, ironically. So for people that are all calling for a big market crash, I'm not convinced that necessarily can take place in an environment where you have a lot of other capital is being restricted and shut down, because it has to go somewhere. So, if you've got a bucket that's quite full and you've got 3 other buckets that are full, but those 3 other buckets have to be emptied and they can go into the one bucket, it can get much fuller and start overflowing. So, because these are exogenous sort of events, right? They're not sector oriented. It's not like you're sitting there saying, is there something wrong with my thesis about coal or anything of that nature? It's more around these crazy politicians doing what every time governments get completely broke, they take actions that are designed to bail them out and justify theft. And so we're at that point in history where I think that starts happening. So that's the other one I'm focused on.
Understood. Well, hey, anything else you guys want to talk about before we wrap up?
No, thanks, Dan. You've done a great job.
All right.
Fantastic.
Well,
thank you.
Well, I highly suggest my audience check out Capitalist Exploits. I'll have the link to their newsletter down below. You do get a special $1,000 discount if you click on the link down below. Again, it is my favorite newsletter, guys, so be sure to check it out. Chris and Brad, thank you so much for coming on, gents. Really appreciate your time. And I'll have the links to all of your socials, your newsletter as well, in the description box, as well as the pinned comment. So be sure to check it out. And with all that said, I appreciate your time for making it through the video. Thank you so much for watching. Be sure to give us a like, subscribe to the channel if you haven't already, comment down below. Let me know what you think. Do you agree? Do you disagree? Really interested to get your take. And with all that said, I'll catch you next episode. Bye, guys.